All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have Andrew Freedman. Andrew is a managing director at Hedgeye. Andrew, how's it going?
It's going well. Thanks for having me on.
Great. Hey, let me start this podcast the way I do every podcast. First, a quick disclaimer. Andrew and I are going to talk about a lot of stocks today, so everyone should just remember nothing on this podcast is investing advice. Everyone should do their own work, do their own diligence. And then second, with a pitch for you, my guest, I love to talk about the media space, the telecom space, all this. And whenever I do and I get something wrong, there's just trolls everywhere saying, you got this wrong. You're so dumb. I knew it all along. But there are very few people who can point to, hey, I was writing in real time about this. And Andrew's one of them. When I came out and said I was long Altice, a couple months later, people will come back and Andrew said, look, here was my thesis on Altice, why it was a bad idea, which it really was a bad idea at the time. But look, I love the way you're looking at the world. I've reviewed your coverage list and I know the way you're looking at the world it's really working today. So I'm excited to go through all of TMT and have this conversation. So that all out the way, TMT is a broad space. Let's talk about, maybe we can talk about what you're seeing right now or just how you're kind of view the world in general.
Yeah, sure. I mean, look, I think just to kind of kick things off, it's probably helpful to just, tell folks how I think about the world, our process, because it's a little bit different. So first, Hedgeye, we're an independent research firm. So we don't do any asset management. So when we say we're long, short this, it's a research recommendation and we have various levels of conviction on our ideas at any given time. But in terms of the process and how I come up with ideas, it's very dynamic, right? So we think across multiple durations. We get criticized as being too short term, which I understand. But it's also important, I think, to really understand your catalysts and how fundamentals are trending in the very short term. And that's really key to the process, which is also very data driven. So we use a lot of data inputs to kind of understand how the company's fundamentals are trending. You never get real time, right? But if I can kind of get a sense of how the business is doing intra-quarter using some third-party data set or some, primary research efforts, that's super helpful in trying to, understand, when we should, crank up or crank down our levels of conviction on a specific name. And, we'll get stuff wrong just like everybody else. But then in the long term, we have, at least for me, a very, thematic process, right? So the communication services space, which I've deemed everything internet, media, cable, telecom, is very rich with very long-term secular trends that are investable. And if you can get those right, and you can also kind of navigate the cyclicality and the ebbs and flows within those long-term secular trends, I think, you can come out with a process on the long short side that can create a lot of value. And I guess the other thing to just mention here is that, the way I think about the world is through a long short framework. So I think a lot about relative value, what's going to work relative to this. And so, it's not necessarily an absolute value, right? So when I look at my ideas on the long and short side, it's like, okay, we're long Twitter. It's been absolutely a disaster and very painful of late. And we can get into that if you want.
Oh, but I want to talk Twitter for sure.
But on the other side of that, right, we've had a very negative view of digital advertising, just given the comp dynamics, IDFA deprecation, data privacy issues, the list goes on, which, gave us a lot of conviction and helped us time really well our shorts on Pinterest and Snapchat, which are two of our top shorts at the moment that we got right into earnings against our Twitter long, right? So, we're not actively managing money and, obviously being able to manage position sizing and managing those kind of gross to net exposures is very challenging. And so, but in that sense, that's how we at least communicate our ideas. It's very rate of change focused, but at the same time, we also build models and I pay attention a lot to like the key drivers of the businesses and how I think the fundamentals are trending both in the short and long term. So that being said, if I kind of talk out of both sides of my mouth or, I talk across durations, that's probably, that hopefully that helps kind of frame things up.
That makes total sense. Hey, let me start with something that you mentioned there. And one of the things I like is, most of the time when you have a sell side analyst, their list is, if they cover 20 companies, it's 17 buys, 2 neutrals, and maybe 1 sell. But I mean, your sells and longs are actually pretty balanced. I'm looking at right now, it's like 15 longs and probably 12 shorts.
So, although I will stop you short, Andrew. The fact that you're calling me a sell side analyst hurts me a little bit. I know that's technically what it is. I know, but like in terms of how I feel and think, usually we're poking holes at the sell side because we are independent, right? And so I don't get paid off of management conferences. I don't get paid off of saying great quarter guys. I don't, we don't have any banking or trading, right? So in the truest sense, I'm just trying to, do buy side quality research and be right at the end of the day. But so how to say that.
It makes so everybody wants to be unique, right? But let me start. You mentioned long Twitter, short Snap, and Pinterest. And I just thought that was an interesting combo because, most people I know who are bullish, Twitter, Spotify, Facebook, Roku, which I know you are, I think tend to be bullish, especially Snap and Pinterest. And now I don't follow Snap and Pinterest super closely, but I'm just in general, they tend to be bullish on this. So what about Snap and Pinterest in particular kind of drives you to look at those as shorts?
Yeah, so I mean, the timing was interesting, right? And a lot of it's looking at what the drivers of the business were and why they worked so well for so long. And really, it came down to a couple of things, right? They benefited disproportionately coming out of the pandemic last year. So while the world was going through a very difficult time, there was civil unrest, we all know, so we don't have to recap 2020, but it was really a bad environment for brand advertising, and really resulted in a lot of large brands and agencies to shift their ad spend to other platforms. So, given how large the digital advertising market is, right? If you just pick up 50 basis points of market share, it's incredibly accretive to your growth rates. And so that resulted in, a massive positive revision cycle, a huge acceleration in growth for Pinterest and Snapchat coming out of the pandemic, which lasted about through, this, the second quarter of this year. And as we were kind of going into the back half, valuations were incredibly stretched. We were just coming off this massive positive revision cycle. At the same time, growth was going to slow. And we thought that a lot of these, tailwinds of these businesses were going to revert, and that people were mistaking, basically extrapolating all this positive growth into perpetuity. In the case of Snapchat, you're sitting there looking at, consistent 100 basis point market share gains a year, 60%, 3-year CAGR in gross profit, where we thought that, this was maybe more of a temporary boost. And the company just earlier in the year came out and said, look, we think we can grow 50% a year forever. And they did that right at the top, right as their business was absolutely the best it was going to be. And so we saw effectively mean reversion, right? But, there's a good opportunity to peg the short. And I think we timed it pretty well ultimately. And the same thing with Pinterest. Obviously, they've been seeing very weak engagement trends. So they're a little bit more nuanced, right? Because it's not really a social platform. It's more of a search platform. It's more of a content platform. And so they benefited a lot, in COVID from the stay-at-home trends and things of that nature. And when we were coming into the year, we were concerned that, again, we would see a lot of those positive trends reverse. It's a leading indicator, right? So search is intent for Pinterest. It is very top of the funnel in terms of user behavior. You're talking about weddings and things of that nature that are planned events. And during COVID, a lot of those things got put on hold. And as a result, you saw people's engagement, the time spent with the platform, go from like 12 months up to 18 months. And that has, in a normalized environment, has since reversed. And then you also just have the general, reopening trade that's been occurring, which has resulted in them losing a lot of the users that they've had, which isn't good for engagement trends. It's not good for monetization. Time spent in the app has gone down. And we've been tracking a lot of the data there fairly closely to monitor those trends and help us, build conviction. And, looking in Q4, they just guided to the slowest growth rate out of the group. I know, and I'll stop after this comment, but I know long-term, a lot of people look at Pinterest and Snapchat and they say, look, these are great platforms at scale. Direct response advertising is the fastest growing part of the market. And while that is the case, there are a lot of challenges that these businesses are going to be facing specifically currently, and at least through the next 6 months, which is why we're seeing the multiples come back in. And we're seeing this across all quote pandemic winners, right? It's all going back to where it was before.
Just on Pinterest in particular, it strikes me because I kind of threw it on my list to look at and haven't gotten fully around to it. But, there was the rumor Microsoft offered to buy him for 80 over the summer. There was the rumor, I don't even think this was a rumor. PayPal put out a press release that said PayPal offered 70 and PayPal's shareholders kind of revolted and PayPal stepped away. But, the stock, I think it's like 40 as we speak. Is that right? I don't have it.
think it's down more. I think it's 35, down 6%.
Ooh, just going straight down.
Going down, man.
Yeah, when I look at a stock at 35, where less than 2 months ago, there was a strategic who was talking about paying 70 for it. I look at that, and Microsoft and PayPal are two of the world's biggest companies, and both of them looked at Pinterest and saw something strategic where they were rumored within the past year to pay a huge premium to the current price. I look at that and say, oh, that seems kind of scary as a short. Are you not concerned about kind of the Pinterest strategic interest, M&A target, all that kind of circle?
You go back to like October. Well, first of all, when that Microsoft news came, it actually made me more bearish, right? Because at the time it wasn't necessarily a premium to the stock. And so then when you have that floated out as a price, you're like, all right, my upside's capped. If I think the business is
that's a great point. Yeah, that's
a
great point.
That's one thing. The second thing is, yeah, it's super scary because I mean, we communicate ideas, and you probably see this, Andrew, on our position monitor. We have our active longs and then our bench names. And the active longs are ones that, we have more conviction in at the moment. We think, that they're basically in play, right? And the bench is more longer term, thematic. We may have not gone all the way through the investment process. So when we had Pinterest on the short bench, going into earnings, and we had the PayPal news, and yeah, it was terrifying. Like, it was awful, right? It's a squeeze. The stock went from 50 to like 63, and then that kind of, it turned out to be nothing burger, and then we added it back on as an active short because we saw the business deteriorating. Look, I think what it comes down to is, when the Microsoft bid came out, what was the business doing, right? They were just coming off of a breakneck year. The fundamentals still looked really good. Fast forward to the potential PayPal rumor. It was lower than the Microsoft bid rumor, right? The business fundamentals were getting worse. And so the fundamentals continue to slow, right? And so does it make me concerned? Yes. But if you're a potential strategic here, is there a sense of urgency to buy Pinterest if you think you could potentially get a better price for it? I'm not privy to those conversations, right? I don't think most are. But if the business is at 35 today, maybe you can get it at $50, right? It would still be a big premium. And the strategic value is there in the sense that, having, commerce conversions on platform in a world where you have, limited visibility with IDFA deprecation, to integrate payments to better track, conversions for shopping. It makes a ton of sense. I just don't know if Pinterest is the right platform, right? Because they don't have, they have a lot of MAUs. The actual engagement levels of those MAUs is pretty low, and it hasn't really shown an ability to scale outside its core demo of females, which is a good demo. It's an attractive demo, don't get me wrong.
There are a lot of females out there.
Yeah, and they monetize really well, right, for shopping. But still, like, I don't really know if Pinterest is really the right horse in that sense, if you're PayPal or some of these other platforms. So that's kind of been my sense. And yeah, I mean, M&A is scary, but it's always a risk, right? Like, I remember when we first went short Altice in December of 19, and the feedback always was like, Charter's going to buy it, right? Like, or Drahi's just going to come in and take this thing private. I mean, Dexter at a cocktail party with our director of research after we went short called our report cute and said that he'll just go and buy back all the stock.
Yeah.
Right. Which he proceeded to try to do. But the point is, it's in my process, like, I try not to really be too concerned with M&A. But yeah, I'm probably going to get blown up on it at some point with something.
Well, we don't have to talk about Altice, but I find it's funny. I mean, look, you put this all in your short report, but Altice in 2018, 2019, they definitely had an arrogance to them, right? Like you said, he called his report short. Yeah, every conference they went to, they'd say, hey, our free cash flow yield to equity is 10% and our debt costs us, 3% after tax. We're going to take advantage of that all day long. We're going to buy back shares. They called Charter and Comcast stupid for how they were launching their mobile business. And Altice was like, the Altice way, we're going to have the best mobile business, going to be cheaper, more profitable, all this. And, they cut costs like crazy. And this year, stock way down. It's my biggest loser by far. And they're out here, everything's gone, right? No more share buybacks. They're reinvesting in the business and paying down debt. And despite the stock being 50% lower than where they were hammering the share count, Altice way is dead. they're reinvesting into the business. The mobile plan scrap. They're redoing all
Yeah.
like it just shows an arrogance to them. But anyway, let's go back to telecom, or you can talk Altice if you
No,
want
yeah,
to.
no, I didn't want. I only brought Altice up because you asked the M&A question, right? And I
Yeah.
thought it was a good example of like how I think about M&A on from the short side. So we don't have to get about that.
Yeah.
But yeah, I agree. I mean, if you notice, we're not short Altice at all. Like it's nowhere on the list right now, right? Because for the reasons that you mentioned. So.
Well, let's talk just one more in the tech space. Twitter. You know, I've been a longtime Twitter bull. Fortunately, don't have a position currently, but Elliot Turner came on the podcast right after they kicked Trump off, and we talked about it. And you know, me like many bulls, I look at Twitter and I see this platform where I create tons of value. You and I connected on Twitter, right? Like all this value is creating. It drives every news story. They literally, you know, not to rehash the story, but they kicked Donald Trump off and Donald Trump's microphone is literally taken away. Without Twitter, you don't have a microphone, you know? So I look at this and I see what I think is maybe the most powerful platform in the world, and it's trading for $40 billion on the open market. I haven't looked at the EV since the huge stock price drop in the past couple of years, but you know, they can't figure out monetization. Every time it seems like they're getting something going, they kick themselves in the foot. And, you know, the bulls have always said they just redid their tech stack. Things are accelerating. It just doesn't feel like it. So what's going on with Twitter? Why can't they figure out this monetization? Why does the stock suck so much?
I mean, I think the stock sucks so much. Well, there's a lot of reasons. First of all, everyone wants to be long performance, direct response advertising, right? Twitter is 85% brand advertising. It's not really a growth market. It's highly cyclical. The return on ad spend isn't necessarily extremely high, right? But it speaks to the fact that Twitter is an amazing awareness tool, right? It's broadcast. It's phenomenal in that respect. And because of that, you just don't inherently get a large multiple for brand advertising businesses because it's slower. Now that's why they're moving trying to get from 85 brand to 50-50 direct response. If they can successfully grow that business, then you know you can start to see the multiple re-rate and their growth rate to be more durable over time. So there's that aspect of it, which I think is an overhang. The other thing too is, look, there's just so much scar tissue here. I think it's just been such a chronic disappointment. The Twitter long thesis isn't necessarily new. It's been talked about in many different ways. And it just hasn't worked. And right, so investors just become tired at that point, right? The opportunity cost of being a Twitter bull or being long Twitter is just way too high. And so let me just be long Facebook, which has been a better idea, right? It's on the long side. But again, you look at Twitter and you just can't help but see the optionality in the business, all these levers that they could potentially pull to create shareholder value. And on the one hand, if you look at what they've been doing, I think this is not the same Twitter that it was 3 years ago. They have been executing against their plan. They've been, you know, product development velocity has more than doubled. If you look at their market share of digital advertising dollars compared to peers, it's stabilized and it's starting to turn. Brand advertising has snapped back. They've gotten their Map 2.0 back online for mobile app advertisers. That's growing quickly. And so if you just look at what they're doing, they're executing, right? And actually the fundamentals of the business in terms of revenue and users have come in a little bit better than even I was anticipating coming into the year, which is the exact opposite of like looking at like a Pinterest or a Snapchat, like in the most recent quarters where they've disappointed. But nonetheless, right, we're seeing a slowdown across digital advertising, tough comps, and the whole group is re-rating lower, right? And so you're going to have that issue where Twitter's relative valuation is going to be tracking peers. And so if, you know, Snap's going to go from 20 times sales to 10 times sales, and Pinterest is going to go from 15 times sales to 7 times sales, right? You're not going to see Twitter's multiple or valuation stay constant relative to that. So I think that's a big part of the issue that we're seeing recently. And frankly, you know, it's also obviously no one believes their MDAO guidance. I think it's mathematically, if you just look at the numbers, it's very difficult to just look at the past and say, can they get it going forward? That being said, I think, you know, there are levers that they have at their disposal to hit that number ultimately. whether it's some converting some products that currently don't have exposure to advertising to ones that do. And then you also have to think about all this product, all the investment that they're making in use cases like spaces, communities, super follows, that maybe are not necessarily big monetization drivers directly, but what they do is they have the effect of driving higher engagement and increasing MDAO conversion, which is incredibly important. And the last thing I'll just say there is I think people are way too, like, they look at the very short term and they don't realize that, I mean, coming off of last year's political cycle and the engagement trends that we saw, the fact that they're actually growing users, still in 2021 is actually pretty impressive. So we'll see. We'll see how it ultimately plays out. But yeah, it's definitely been the pain trade. It's been disappointing.
Obviously this week, Jack steps down, resigns, fired, whatever you want to call it. They replace him with an internal candidate. Just quickly, what were your thoughts on the CEO switch?
I think that, like most, I thought maybe doing an external CEO search and bringing somebody fresh in would probably be better. But at the same time, if you think about that, if you were to bring in a brand name CEO, they're going to want to put their stamp on the organization, right? And they've already pivoted this organization in a strategic direction, 18 months ago. And so to all of a sudden take it in a completely different direction, right, would be very disruptive in and of itself. And then you also have to think about, and then you just have to think about just how long it would actually take an outsider CEO to acclimate to the culture and really understand what's going on and add value, if at all. And so I think that in that framework, elevating Parag to the role that he's in now makes sense. And frankly, the other thing too that we have to keep in mind here is like what the strategic options are, and if this company is going to be taken private, either private equity or strategic, are you going to bring in a brand name CEO who's going to want to be here for 5 to 7 years? If really the name of the game here is just, who cares? They may not even hit. It may not even matter what their 2023 targets are, right? Yeah. They could just be like, what they may believe them, they may not. I don't know. But if they have plans on taking the company private, it's not going to matter.
The taking the company private is an interesting thought because, they loosely fit into just about everyone as a strategic player. Now, Google, Facebook, regulatorily, there's no chance they acquire them. But Iger's book, he says we had a deal to buy Twitter, and I called it off like a couple hours before, if I'm remembering correct, a couple hours before we were about to sign it, if I remember that correctly, because he didn't like what a toxic pool it was. But every media company Twitter would make sense for. Twitter and Spotify could make sense. Twitter and Netflix, if you really stretch, could kind of make sense. Like you could basically see Twitter as it's strategic to just about everyone. It's interesting. I haven't heard a lot of buzz around that. And then on the private equity side, this is a famous thing, but Twitter spends $1 billion on R&D, and what the fudge are they spending $1 billion in R&D on? The site hasn't improved in years. Interesting what you said about bringing a new CEO in, because that was kind of my only concern. I thought Jack did fine, but I thought they needed a full-time CEO for a company this important. And my only concern with Jack leaving right now was, we're supposed to be on the accelerating ramp, right? Like they paid off all their technical debt. They've got all their ad targeting stuff where they supposedly want it to be. Active users are supposed to be ramping. Revenue is supposed to be ramping. We're supposed to be ramping up, and you switch CEOs right as the ramp up happens. That's always a little concerning.
Yeah. I mean, I guess my only thought on that is, look, Jack is an incredible barrier to attracting investor capital.
Yep.
And love him or hate him, he needs to, I think, and any way to get the stock higher he needs to go. And I think that this transition plan has probably been in the works for a long time here. And also, again, if you have plans on selling the company in some way, shape, or form, right? If that's ultimately the path we're on, Jack doesn't need to really be there anymore. If anything, it makes it worse. And he's also giving up his board seat next year. So
yeah, I thought that was interesting, having Jack, the founder, give up a board seat so quickly. I thought that was pretty interesting.
Yeah. So anyway, but that's just my 2 cents on it. I mean, I think it's I think what your perspective makes a lot of sense too. I just I just don't know if Jack is really going to be the one who wants to see this through, who's going to carry the torch for this next wave of growth. Obviously, it's not the case, right? Because that's what he said, and that's why he resigned. But I think that it's probably for the best interest of shareholders, and whether or not the next stage of value creation for Twitter is going to accrue to public equity holders today, or maybe in the hands of private equity, I don't really know. But I can see multiple paths going forward. But yeah, Twitter's been, very tough, and the narrative shifts have been really difficult to manage because people got way too excited about some of their subscription initiatives around super follows, and there's a lot of hype and excitement because all their power users see how much, who are also investors, see the value in the platform. But ultimately, I think what it comes down to is just like, how do you get revenue to grow faster? You got to get into direct response advertising. It's really that simple. So what they're doing in shopping is interesting currently. Business profiles, they need to get more SMBs on platform. And also too, and this is the last thing I'll mention on Twitter, is like, let's just be real, right? Like imagine managing this organization, like put yourself in the operator's seat. Change doesn't happen overnight.
Yeah.
It takes a long time to, turn a ship the size of Twitter, right? And I know investors just want to get paid tomorrow and they want to see change immediately, but the reality is that doesn't always happen, especially for turnarounds. So we'll see how this ultimately works in their favor or against them.
Yeah, I just, when I look at the platform, I was messaging Elliot about this the other day. I don't think he responded, but this is a little half-baked. But when I engage with companies, I tweeted this a couple months ago. I was calling Delta. I had a COVID exposure, had to quarantine, had to cancel flight because you had a COVID exposure. Calling Delta, trying to cancel my flight day of. Wait time on the phone is 4 hours. I tweeted about it. I was like, hey, I don't know, like it's 3 hours to JFK until my flight. I don't know if I'm going to be able to cancel this before they actually pick up the phone. Tweeted out, Delta representative DMs me 10 seconds later. Everything's taken care of over Twitter DMs. And that's pretty much how I engage with most brands now, right? I slide into their Twitter support. I just message them on Twitter and say, hey, can you help me? And I don't believe Twitter makes a dime off of all of the support functions. And I've always wondered, like, it just seems like that alone, it shows the strategic value of Twitter, how much capture. And it just feels like there's a lot of value out there that they could take in different ways that they're really not getting paid for.
So I have my own story, which I'll share in a second. But I think the fact is that Twitter is such a powerful organic marketing tool, right? And organic marketing is the best kind of marketing. It's the most effective, it's the cheapest. And because it's so good, it makes it less effective to actually wanting to pay and monetize if the organic is so strong, right? So if you have a great following, those are the people that are likely going to, if you're looking to monetize your audience, those are the ones that are a high probability. And so you can do lookalike audiences. You can do a lot of things on the promoted advertising side to try to grow your audience for sure. But the fact is that it is such a great organic marketing tool that it actually almost works against them in some ways. And then my own little story was like, this was like 2 months ago or a month ago, I switched to T-Mobile and I had a software upgrade and it didn't work. And I went to the store to try to fix it. There was some issue with the computer. I waited like 36 hours. I went back, it was a Friday. They said they couldn't help me. I was supposed to go on a business trip that Monday. I needed my phone. And then they were like, too bad, it's not going to work. I tried to support. I literally got on Twitter and I tweeted at John Freer, who's their head of the consumer organization. And he's in my DM like 15 minutes later. I got like the chief operations office, the COO for the Northeast division calling my cell phone. And I have a new device in my hand within 45 minutes.
Yep.
It's just like the power of the platform is phenomenal.
Now, someone has told me, they were like, look, you guys have more than 10,000 followers, which doesn't make us gods among Twitter users, but it puts us well above average, right?
Yeah.
And they're saying, hey, I think the companies on Twitter do know if it's somebody who tweets at you on Twitter, they're much more likely to, engage really heavily on Twitter. So if you don't treat them right, they're going to be spreading vitriol. And, even if it's a guy with 10 followers, it can go viral very quickly. And if it's a guy with 10,000 followers, it can go viral very quickly.
Oh yeah. The cost, right? The cost of having somebody with any followers are like, the net classic like net promoter score, right? Like your detractors, like negativity and detractors are amplified, right? It's just like in real life, right? When something bad happens to you, it feels a lot worse a lot of the times than when something good happens, right?
Yep.
Loss aversion in investing, like, and the same thing can be applied when it comes to marketing, in that you want to neutralize, right? Because you have that complaint, right? But then if you can actually take that complaint and turn it into a positive outcome by fixing it, and then they promote that outcome, that's actually worth like 3x, right, than any other type of organic promotion or any type of other positive experience that you would get, because it shows that you're committed to fixing problems, that you care about your customer. So in that sense, you're spot on.
Yeah, and no, I 100% agree. I just thought it was interesting because my worry with Twitter and my worry with a lot of media companies is if you love them, right, you're going to see all the bull cases. You're going to see the optionality, and it can be hard. And when someone said, hey, I worry with Twitter, I've got to bias use it because I get so much value out of it. I enjoy it so much. I'm sure you're the same. But somebody was saying you might have a little bit of a biased view of the product and the optionality just because of how you interact and engage with it.
Yeah, I mean, like the reality is that there's a long tail, like any type of media platform, right? Like you can look at Netflix consumption, you can look at Spotify streams, right? There's always going to be, that long tail of, users and consumption across the board, and the value is not going to translate equally, to everybody, right? There's a lot of people that are attached to Twitter kind of on the margin, right, that don't engage with it daily. And so there aren't as many, like the value, like they monetize me really well, right, but they're not going to monetize the long tail as effectively, which is the whole point of the strategy. Give people more reason to engage, get that MDAO conversion higher, and then hopefully that translates into faster growth over time. But yeah, no, I think the bias is real. I mean, at the same time, from my seat, I try to neutralize it within the process, right? So like, what are my key thesis points? What are my fundamental expectations? What are my catalysts? What is my perception of value, right? And so as long as I kind of have my true north and I don't really feel like I'm deviating from that in too many ways, then I feel like my bias is a little, neutralized. But yeah, I mean, look, people, like, we all grow up in this business and investing, right? And what's the first thing that you're taught? Like, buy stocks in the companies that right, that you enjoy, that you're a consumer of. And in that sense, maybe everyone has biases, right? But I think that's why it's important to have a thesis and really be able to be objective.
Let's leave the I guess social network space, sure, tech space right now, and let's go to one of my favorite spaces, the media side, right? Yeah, I know you cover. I'd say you've got the classic. We're bullish on the future of media, the Netflix, the Roku, and even Disney in there, and we're really bearish on the legacy media companies. So I'm thinking about Viacom and AMC networks right now. So yep. I guess my first question would be like, how cheap, when is Viacom a buy? Because I've looked at this company so many times over the years. It is so damn cheap. It's, as we're talking, it trades for about $30 per share, which that's about 35 billion enterprise value if I'm just eyeballing it correctly, which is, it's 8 times EBITDA maybe. And
7.5, yeah.
Yeah, and they've got a lot of, if they really wanted to juice, this is one thing I've thought about, like, if they really wanted to juice their EBITDA, they could just shut down Paramount Plus, license everything, like there are real assets in there, right? They've got good brands, Nickelodeon, SpongeBob, Star Trek, like there are real assets in there. It's very cheap. Viacom, I actually really like the Bob, the Viacom CEO, but like, when is it too cheap?
Yeah, so I mean, valuation is, for me, it's kind of like the last thing that I do, right? So I don't start with valuation. I start with, what is the top-down secular trends of the business, and then from there, like, where are the fundamentals of the business trending, and then what do I think the future EBITDA, cash flow, whatever the key metric is that I think the stock's going to anchor off of, like, where do I think that's trending 3 years from now? And then I kind of think about, okay, what's the right multiple, and then what does the multiple track? And just from a thematic standpoint, maybe just to kind of step back for a second. I mean, we've been on both sides of these names historically. I've been long Discovery. We're not currently involved in Discovery. But look, I think you have to realize that there's a massive shift that's been ongoing and it's continuing, right, in media, and that's the transition to streaming, which has implications for the unit economics of these media companies, right? So, it weighs on affiliate fees, it weighs on advertising trends. And so if you look at, in the case of Viacom, in the time that this merger closed with CBS, in their pitch book, they said 500 million in annual cost synergies, pro forma adjusted OIBDA of 6.3 billion, right? And this year they're going to probably do 4.6 billion in OIBDA, and it's going lower. Free cash flow in 2019 was 1.24 billion. This year it's going to be 1.1 billion, and it's going lower. And so in that sense, I think you have your classic value trap, right? Where cheap gets cheaper because the fundamentals continue to be challenged. Now, yes, they're growing streaming very rapidly, and they have grown their subscriber base for Paramount Plus and Pluto much faster than I initially anticipated. Granted, they've done a lot of other things in terms of striking distribution partnerships that help keep that number growing at a faster rate since then. But the point here is that streaming is just a much less profitable business compared to linear. So you're driving inferior unit economics through the model, and 90% of your cash flow is still coming from these legacy linear advertising and affiliate streams. And in that sense, like, what's it worth, right? So, let's say they're going to do 3.5 billion in EBITDA in 24. The street's currently at like 4.5, 5. Maybe you pay 7 times on that, and you get, an EV of 25 billion, less net debt of 14, 10.5 equity, and you get a $16 stock. At 8 times EBITDA, it's 22. And so I think the bulls want to be able to look at this and say, look, it's a sum of the parts, it's streaming, it's growing quickly. Let's give it a per sub valuation on the part of Disney or Netflix. And I just don't think that's the right valuation approach.
Let me push back on a couple different points here. And I don't have a position in Viacom right now. So fine. I'm just fascinated by it. But there's two, I guess my first pushback to you would be, okay, I hear you on that, but I look at something like Nexstar, which Nexstar is the affiliates, right? So if you're living, you watch CBS on for people who watch, on linear networks, CBS is actually owned by an affiliate. So Viacom owns the CBS overall network, but the affiliate runs the local news, all the programming and stuff. Nexstar is an affiliate of CBS. Being an affiliate's a worse business because you have to pay CBS network a big revenue share, basically, right? Nexstar trades at 7 or 8 times EBITDA. Viacom trades at 7 or 8 times EBITDA, right? So I've always looked at it and said, well, an affiliate is a worse business than the network. Obviously, Viacom isn't all CBS. They've got a lot of other channels in there, and Nexstar's management is second to none. But I've always looked at it and said, relative value-wise, like affiliates going for 8 times, and you see credible players. Tegna's getting bids from Apollo right now. Tegna's another affiliate. They're getting bids from private equity players to take them out at like 7 or 8 times EBITDA right now. Gray just bought television stations from Meredith. Like 7 or 8 times EBITDA is how much affiliates are worth. If they're worth 7 or 8 times, isn't Viacom worth more than that? Would be my first pushback.
Yeah, I mean, within that framework, I think that is reasonable, right? If you look at historically, like what broadcast EBITDA multiples are, high single digits, maybe 10 times at the high end, like 8 to 10 times. Cable is what, 4 to 6 is usually, the valuations that you see
for cable stocks. Or cable networks.
Yes, no, not cable company. The cable network.
I was about to say, take that back. Only Altice trades for 6. Charter's an even 10 or 12.
Blasphemy. Sorry. Not that. But yeah, just cable networks. And look, what's Viacom worth? The cable nets, post the merger closing, right? Like the stock went down. Granted, that was COVID, but you saw like Viacom value just disappear. And we were short into that, and we covered it like at the 12 because it was just the valuation was just kind of absurd. But yeah, look, you can look at like relative valuation comps, things like that. For me, what it really comes down to is, if I think that EBITDA is going from 4.5 billion a year to 3.5 to 2.5 to maybe 2, right? Then this business isn't trading at 7 to 8 times. right? It's already trading at, 10 times. And so then you have to think about that re-rating that's going to continue to happen as estimates continue to go lower. And then it just becomes a question of like, do you think that they can get to scale in streaming? And by scale, I mean like actual like profitability, right? Not just like sheer number of subscribers. Like, can they actually leverage their content costs to drive, better unit economics to get to, a larger EBITDA base, that higher level of incrementals and flow through the model years out. And, I have a really hard time getting there. And it's not just Viacom, right? I just think that streaming is just structurally a pretty terrible business, at least, at these current prices. Maybe down the road, if the bundle ever goes to zero, we're all paying like, $35 for Netflix and $20 for Paramount Plus. I don't know, right? But the
unbundle to rebundle. Well, I've got some more Viacom questions, but let me flip it then. So I agree with you. People are learning quickly that streaming is harder. You have to get a lot of scale to justify the big content spend, right? Well, you've got Disney and Netflix on your buy list, and they're different. Netflix is the #1 winner. Disney has a brand and they've got other stuff, the parks and everything are incredible businesses. But when I look at that and you say you've got to buy there, I mean, Netflix is way more expensive than Viacom. Now Netflix is growing and they've got a dominant position. But, if you're starting to question how profitable streaming can be, you look at Netflix and you say, oh, well, there is a lot of competition and the competition is getting funded by hugely deep pockets and Amazon Prime or Apple TV or stuff, or it's getting funded by, legacy cash flows that are going down, but that are real, that can fund a lot. And they do spend a lot on content in a Viacom, a CBS, all this. So why are Netflix and Disney buys with all these questions while Viacom's a sell?
Yeah, well, it comes down to a couple of things. First of all, we've been bearish and mostly wrong on Netflix for a really long time. I mean,
actually, when you sent me your list, I was like, I'm pretty sure Andrew has been a Netflix bear. I didn't realize that he was.
Yeah, no, definitely for a really long time. And I still, believe a lot of my initial viewpoints, right? And just in terms of valuation and market dynamics, what's baked into the valuation, I don't believe that they're going to be able to get to like 350, 400, 500 million subscribers. I mean, still, right? But, in the spirit of like, either, wanting to be intellectually right or actually help people make money, right? I'm very much so focused on helping people make money. And so in the shorter term, we pivoted to kind of the long side, and it's not a high conviction long. But we're coming up against easier comparisons on subscriber trends. Their #1 driver of subscriber acquisition being content was ramping back up, and the data we were tracking was getting a lot better. At the same time, everything else looked like absolute crap in our space. Advertising was going to fall out of bed. We're coming up against more difficult comparisons with the reopening trade. And so it just made sense that I thought that Netflix could start outperforming. And so that's why we pivoted. And we'll see how long we stay there, right? Because we can go both ways. But the point is, like, it doesn't mean that I think that Netflix is a great business, or that I think that there's a sustainable path here to significant free cash flow generation while maintaining their current rate of subscriber growth, because I think the end market is ultimately not going to show up. That being said, it's still a pure play in streaming, and if you just look at at least the reported metrics, right? EBITDA is still growing, earnings are still growing. You can talk about accounting nuances and how they account for their content costs and all that stuff. It's probably not worth it to get into here. But, the question is, like, in that scenario, right? Like, I want to be long Netflix against short Viacom, because Viacom is coming up against the product launches. The linear business is coming under pressure. As they comp these affiliate renewals at the same time, we're comping against the big increase or the resurgence in linear advertising trends, right? That happened post-COVID. And so that business is going to slow very quickly at the same time on rising content expenses, while Netflix business, at least on subs, is going to stabilize and potentially positively inflect. And in that scenario, I think that works. And then for Disney, you know, we were big Disney bulls going into the Disney Plus launch, right? Like our view going into this from day one was that they're going to surprise the upside. And this was before on subs. And this was before anyone was like, everyone thought that, you know, no one could do it but Netflix, and no one was going to subscribe to all these services, which ended up being, you know, not true. And we did a lot of like survey work to kind of build our conviction, turned out to be right. But you know, if there's one company out there in legacy media that has the brands, the franchises, the ability to, you know, transition the base over to direct to consumer, it's Disney. But still, like, it doesn't change the reality that, you know, ESPN is still, you know, a large percentage of their free cash flow, right? And so the question is, you know, do you believe they can get to scale in streaming and they have this incredible free cash flow that they can just leverage to reinvest into streaming, which is great. And I think that, but I still think the jury is out whether or not it's going to actually be profitable for them and to what, you know, scale. So it's.
What do you think Disney should do with ESPN?
I think that they need to, yeah, it's a good question. I'm not sure I have a good crystal ball on this, but I'm not sure anybody does. Frankly, they need to keep it. I don't think they can sell it because it's so key to their direct to consumer strategy, right? And I know people have thought about that, but the sports is a huge driver of subscriber acquisition for these streaming services, and I do think that if they're smart about it and they can get the rights, that, you know, it could really help drive much higher levels of ARPU and better retention for their bundle of streaming services, which is Hulu, ESPN, Disney Plus, in the long term. But there's no easy answer to what to do with ESPN. I mean, I don't know if you have any thoughts.
No, I agree with you. It's tough because it is just a clunky product in its current form. But, you know, you hear all the time, oh, well, they should just spin it off or sell it. Well, ESPN has crazy synergies with Disney's legacy. With Disney's legacy TV channels, right? The Disney,
yeah. I mean, it's the largest part of the bundle, right? I mean, it's like, yeah.
And if you spun off or sold ESPN, well, you're killing yourself, right? Because Disney's got the most synergies with it. So if you spun off ESPN, all of your legacy affiliate fees goes down, and who's ever buying ESPN is going to have to price in, well, I lose a lot of affiliate fees and stuff. It just makes no sense from that standpoint. And in the future, though, you know, I do wonder if they regret having ESPN Plus and Disney Plus separate. I get that there's cost arguments and everything, but having ESPN Plus, Disney Plus, and then Hulu on the side, it's just a strange thing. But we that's probably too long a conversation for now. Just want to circle back quickly to the Viacom piece, right? Because there's one other thing in the relative value. I already mentioned NXST, but I think there's one other thing that a lot of legacy media investors hang their hats on. You know, when you look at Lionsgate, which probably sells for about $5 billion on the open market now, Viacom, Amazon, and that's Amazon buying MGM, right? Yep. Amazon's buying MGM for about $9 billion. I think the headline price is. Will the DOJ and FTC allow it? I don't know, but you know, that is a market price. And you'll hear Lionsgate say, hey, if MGM's worth $9 billion, Lionsgate owns Stars, MGM owns Epix. Stars is way better than Epix. MGM's library has some real classics in it, but Lionsgate library, way better than MGM's library when you look kind of all in for new stuff. Lionsgate TV production, better than MGM. So Lionsgate would say, well, our comp is $9 billion. We're worth more. Viacom would probably come at that and say, you guys think you're worth $9 billion. Like, we're 15 times better than you guys, and our EV is 35 billion. Why aren't we 50, 70, 90 billion on the strategic value MGM says? So what would you say to people who kind of point at the MGM strategic value, relative value comp?
Yeah, I mean, you look at like, you know, what Kevin Mayer and Tom Staggs is buying, you know, too, and like the valuations that they're paying for some of these independent productions.
When they bought the Reese Witherspoon business for like $1 billion, I can't tell you how many people sent that and they were like, don't they own 4 shows in a relationship with Reese Witherspoon? We have actual billions of cash flow. Like, what?
Yeah, no, absolutely. Look, library value is real, right? Getting access to this IP, it is of strategic value to a lot of these larger companies, but that is the value, right? If you're an Amazon, if you're an Apple, if you're anybody, like, you're not looking at Viacom and you're not saying, you're not looking at Viacom CBS and saying like, oh my gosh, I want all these subscribers, right? You don't want to buy a streaming subscription business because you already have scale in your existing business, right? So for in the case of Amazon, all you really need is IP, right? And to maybe have it be exclusive to help drive, better retention and help fuel Prime Video and meet all those strategic needs. And I think what the market is telling us is that they should be, an arms dealer, right? They should be do the Sony model. They should license their content out and generate, very high levels of return and free cash flow off that IP, and that there isn't really a path to tremendous value creation in streaming. And maybe the stock will get cheap enough, right, where somebody will come in and, put in a bid, right, for that. So I can't really say that, I can't disagree with your thesis, right? I mean, I think it makes sense. I just, the question also just becomes like, all the other relationships within the business, right? Like then you all of a sudden have to buy a broadcaster, right, with CBS. Would Amazon be able to buy CBS, right? Would that pass, antitrust? Like,
I don't think Amazon MGM is going to, so I think Amazon CBS. I mean, I think it should be allowed to, but I just
but that's the point, right? Like the thing with Viacom CBS is that it's not easy, right? If you want to buy it, there's a lot of issues, right? Which is why we're seeing Warner Media merge with Discovery, right? Like it's not Viacom, right? Because there is the broadcaster element here. So
let me ask, you brought up Warner Media Discovery. Very interesting one to me. I do have a position in Discovery, which, like Altice, has not been a great call, but I think that merger is really interesting. I don't believe you have Discovery rated right now, but what do you think of Discovery Warner? Because I think the two arguments are, the bear side is these are two legacy companies merging together. You put two turds together and you get a turd, not a raisin, right?
Get a turd sandwich. Yeah.
Yeah. The bull case, which I kind of subscribe to, is you look at the asset strength and the IP value at Warner, plus the kind of, yes, it's legacy bundle, but it's really nice background noise that gets lots of engagement, is really good for retention with Discovery. You merge those together, there's going to be synergies on the revenue side. You merge those together, I think you've got a great product that's a real third scale player that's kind of in the same league, not quite as Netflix or Disney, but it's really brushing up against them. And you look at the valuation, the combo, it seems very cheap to me. How are you looking at it?
Yeah, and we've been I've actually always historically kind of had a long bias on Discovery, and part of it's because I think they have really unique brands. I think the unscripted space has better economics and return on your content spend than scripted. It's just a little less competitive, and they have their dominant player there. And I think people generally underappreciate like the strength of like HGTV and all these.
And it might be the old thing where most analysts, most people on this podcast are male, unfortunately, and HGTV, even Discovery
Channel, TLC. I mean, like all these things, like they're it's good, and yeah, it's like the pushback is like, oh yeah, why would I want to own Honey Boo Boo, right? But like, I mean, the point
Dr.
is,
Pimple Popper, yeah,
but here's the point. The point is that it still resonates and it has a large demographic, right? And so I think the worst thing that you can do as a media investor, right, is just assume that your tastes and preferences are the same as everybody else, right, in the world, because it's just not true, right? And so you really have to take a little bit more of a balanced approach to how content performs.
And even to add on it, not just your taste and preferences, but what everyone else says their taste and preferences is. Because you remember that old thing where like they used to rely on what people told them to report TV show viewership, and everyone said they watched the news and PBS and no one admitted to Jerry Springer. And then they got a little bit of digitalization, and it was like the news and PBS were way lower than people were reporting, but Jerry Springer was way higher. Nobody admits it, but everybody kind of watches.
Everybody has guilty pleasures, right?
Yeah.
Like everybody has their guilty pleasures that, if you're at the bar talking with your buddies or whatever, you're not going to admit to watching, whatever show, or, it's just where what it is. I mean, I love like, science-based, all the alien shows. I can't get enough of it. You know what I mean? And so I love Discovery Plus. Like I think it's great. My wife, she loves all the Food Network, all these things. So I think it has very interesting brands that are a little bit more durable than people think. And because it's not scripted, you're not subject to the same type of like inflationary pressures on the production side. Yep. And so I think they can, leverage their content costs a little bit better. But that being said, and it's still cable, right? And so cable is generally viewed as, secondary to broadcast, because, broadcast commands premium CPMs and from that advertising side. It also has, a larger reach and a larger percentage of time spent. It's increasingly being carried by, it's also being characterized increasingly more so by higher content costs, right? Especially with sports. But yeah, no, okay. So going back to your original question, I think that it's still, like, if we just look at it objectively, right? If I just showed you this business model, right, and the trends in this business, and I didn't tell you what the business was, right, you would look at it and say, all right, advertising revenue in this last quarter was, actually I have it right here. So advertising revenue this last quarter was 991 million in the US. It's only up 5% year over year. It's down 3% from the third quarter of 19, right? So that is a large percentage of the economics and the cash flow of the business, which is in decline, right? And then you look at it from the affiliate side and you say, okay, well, that's still growing, right? But then you think about it in terms of, like, what is the biggest problem with the bundle, right? It's the rising price, viewership's down, increasingly becoming a worse value to the consumer, which is over time, in theory, driving accelerating churn on cord cutting, accelerating cord cutting trends. And so then you put this thing together with Warner, and you know what they're going to do. They're going to do the playbook that they always do, right? They're going to use their larger scale to go back to Charter, go back to Comcast, go back to all the distributors, and they're going to say, we're this larger organization now, and they're going to use that to their advantage to try to get better rates, right? And that's part of the revenue synergy. Then what is Comcast, Charter going to do? They're going to go back and they're going to pass that through onto the consumer, because they don't want to have, they're not going to lose money on video. They're barely making any money on video, but they're not going to lose money on video, right? And then you do that, and then all of a sudden you're like, I don't want to pay this anymore, right? And then you cut the cord. And so the issue that I see with the merger is that, yes, you have all these short-term benefits financially. It's very financially engineering driven, which I understand, but it actually, over the long term, potentially exacerbates the problem, right? Which is the value proposition of the bundle.
I agree with much of what you just said, but I think they would push back and say, yes, that's the short term, but what it really positions us for is the long term, right? Because you marry the HBO buzzy IP, right? There's nothing to draw people in, like the Game of Thrones spinoff that's coming out, or the movies. HBO's got great stuff there. What they don't really have is that background stuff that stops retention. David Zaslav obviously exaggerating, but he said, I've heard from people. Yeah, I've heard from people, if we could marry the Discovery library with our stuff, our churn would go to zero because we could super serve. So I think what they're thinking is, hey, for the future, we get the HBO stuff, we get the Warner movies, and we marry that with this massive Discovery library, and boom, our churn drops to zero, and we're a truly skilled player. Do you buy into that, or do you think
I think that makes sense. I mean, I think that, I mean, the pushback, or that argument on churn is very fascinating, right? Because I think it's true, right? I mean, the whole, how do you get churn down? You got to increase engagement and time spent with the service. I mean, it's not rocket science. Yeah. And so if you can get all this kind of white noise, filler, B-rated like type content in with this other service, and you can increase time spent, that's great. I think the question becomes whether or not you actually merge the two services together, right? And all the benefit comes from churn, or do you actually try to do like a bundling strategy? Right, because like
Disney does with ESPN Plus, Hulu.
At the same time, you mentioned HBO, right? Killer brands, killer content. Continue to invest in that, right? You also have the Warner library that they're continuing to pump in there too, and the Discovery content's a little bit different than that, right? And so I do wonder what their strategy is going to be ultimately, because I feel like, at least in the US market, Discovery Plus needs Warner a little bit more than Warner needs Discovery Plus, right? And in international, it's kind of flipped. So the churn benefit could be there. You could have a scale player in streaming, sure. But again, then we're coming back to the same question, Andrew, that we were at before, right? Is a scaled streaming player, right? Even if it gets to the size of Netflix, is it going to be as profitable, right, as the businesses today in linear? And I think, as far as I see it, the answer is no, because the bundle's been over earning, right? Legacy media's been over earning for way too long. It's the culmination of decades of just contract renewals, consolidation,
Yep.
right? Launching new networks and trying to stuff everything down the necks of the cable industry, which they're starting to finally push back on. And I think that it's just going to be less profitable, which I'm not sure that translates into shareholder value ultimately. It's going to be really interesting to see how it plays out.
If you read the S4, I don't have the numbers by me right now, but I believe Discovery was projecting for the next 10 years, basically flat EBITDA and cash flow and everything. And, you think about this year is supposed to be, hey, our EBITDA is trow because we're investing $500 million into launching Discovery Plus and the streaming service. Like you would have thought just kind of annualizing that and hitting scale on Discovery Plus, EBITDA should recover. And it was, I think a lot of people were a little surprised that even these industry insiders are saying, hey, the legacy bundle is so challenged, even when we're kind of annualizing this massive investment into tech and platform and everything in Discovery Plus, we're not going to be growing anymore. I think a lot of people were surprised there. Let me ask, I have one more question on Viacom, and then I want to let you just wrap everything up because I know we're running long because I've been having a blast at this.
No, I got time if you need it, but otherwise we can wrap it up, whatever you want to do.
Just last question on Viacom. I think a lot of bulls, and this is a place I haven't been able to do lots of work on because they don't have great numbers, but Pluto TV, which Viacom bought. It's this ad-supported streaming service where you can watch a lot of things on it. Mm-hmm. Viacom bought it for $340 million in early 2019, had 12 million monthly active users. Today, as of August, I don't have updated numbers. I'm looking at a tweet I put out a while ago. I'll put it in the show notes if maybe wants it. As of August, 52 million monthly active users, revenue doubling year over year, a little bit of pandemic benefit, but mainly because it's growing so quickly, over $1 billion in revenue. When I look at Pluto, revenue's 15x in 3 years. They say it's a total home run acquisition. They paid $340 million. Mm-hmm. What's Pluto worth as a standalone business? How have you thought about that?
Yeah, so a couple things. So with Pluto, first of all, for any type of fast service, AVOD service, like MAUs is just a worthless metric, right? It's totally garbage. It really comes down to like time spent and engagement, and all the third-party data that I've seen suggests that maybe they have a lot of MAUs, but the engagement is pretty low, all things considered. And then the other thing you have to ask yourself is, like, when you start to think about Viacom as a sum of the parts play, right? So what is Pluto worth? What is Paramount Plus worth? You have to think about it. Like, what is Pluto worth without all like the Viacom content? Like, if you don't have
exactly. Yep.
Comedy Central, if you don't have MTV, if you don't have the sales force, right? And the way that Viacom's been selling advertising, especially as this last upfront, is all through bundling, right? So the revenue growth rates look great. The revenue looks great, but they're really just channeling a lot of the linear ad sales into Pluto because that's what they think they need to drive the multiple for the stock. And so yes, it's growing much faster. A lot of it's not, a lot of it's kind of manufactured in that way. And so that's why I think if you look at Pluto as a standalone business, it wouldn't be anywhere close, to what it is right now. So I don't know. I think it's an interesting asset. I don't know if the future is really going to be, fast, in the current streaming form that it is. Maybe if they start putting more sports there, doing it that way, but then you have to think about, well, they're not going to give up, they're not going to start broadcasting NFL games through Pluto TV because that needs to go to Paramount Plus, right? So it's just, you follow the bouncing ball and you just don't get to a really exciting place at the end where Pluto is this, diamond in the rough, incredibly undervalued asset, because it's doing the job of, recapturing a lot of those lost linear economics. But ultimately, like, at least in the data that I've seen too, like the US growth has slowed down, engagement levels aren't that great. So, maybe I'm just too cynical, but
no, that makes total sense to me. That makes just, again, I haven't dug into Pluto, but I know a lot of Viacom bulls who look at Pluto and say, look at those metrics. What would this be worth? Especially when SPACs were really hot. They were saying, what would this be worth if a SPAC took it?
I know.
Yeah. Last question for you, and then I'll let you. What's your favorite long in the sector? You cover TMT, you cover everything. What's your favorite right now?
Yeah, right now, it's so hard to find longs. I mean, I think if we're talking like in the next 2 to 3 months, I would say Google probably continues to work. If we're talking, 3 years, I think that, if some of these issues with Roku resolve, right? And, we're not incredibly, like, we've flagged a lot of the issues with Roku and YouTube, and we've taken it down, on the position monitor as a result. But I think that right now at 200, you're getting it for a price where you're not paying that much for the future growth option in the company. And I still think that there's a long tail, and the long-term thesis is there for those that are patient, can take advantage of this opportunity. But it's definitely one that's challenged, but the stock reflects it.
Roku's another one that has a lot of interesting strategic angles to it as well, but probably another conversation for another one. We've run long because I've had so much fun with this. I had telecom stuff to ask you about, but we'll have to save it for the next time. Let me just give you the last word here. Is there anything, we mainly focused on social and legacy media, anything you wish we had covered harder, anything we didn't get to that you think we should have talked about?
I mean, we didn't talk about Fubo, but I mean, I'm on the tape a lot about Fubo. I mean, I think it's
look, Fubo, just real quickly. So for those who don't know, Fubo is basically, hey, we're your legacy cable bundle, except you stream us, and we've got a lot of sports too. It seems the most upside down business model I can possibly imagine. I'm shocked that there are some people who've said, oh no, this is revolutionary. I'm just shocked that sophisticated investors say it. My issue is, and I'll tell you what my issue is. It's the same issue I have with people who are sell side, who say short AMC theaters or short Fubo. It's like, yes, I am 100% positive they are overvalued. You go try and find borrow, and you go try and short a stock that can be up 2% overnight because Elon Musk tweeted about apes or something,
Yeah, no, I hear you. Yeah, I mean, shorting meme stocks has not been a profitable endeavor, to say the least. But eventually, I like to think that it all comes full circle at the end of the day, which you're definitely seeing. But yeah, no, Andrew, this has been excellent. Hopefully I added some value, and I appreciate the great questions and the ongoing debate.
Hey, this was absolutely great. I ran long because I was having so much fun enjoying it. Andrew Freedman, I'm going to have the link to his Twitter profile in the show notes so people can follow him on there, hit him up. He's got a passionate following on there too. So be sure to meet him. But Andrew, this was great. We'll have to have you on maybe after next earnings to do another media recap or something.
Sounds good, Andrew. Thanks.
Thanks, man.